Hello financial fans, welcome back to another stock analysis. Today we'll be covering Bristol Myers Squibb, stock ticker BMY. Bristol Myers Squibb is a global biopharmaceutical company that discovers, develops and delivers innovative medicines that help patients prevail over serious diseases. Their portfolio of products includes medicines in several therapeutic areas such as oncology, cardiovascular, immunoscience and virology. Bristol Myers Squibb research and development efforts also focus on areas such as liver disease and neuroscience. BMY also markets and sells biopharmaceutical products directly or indirectly in various countries and regions around the world. They also have collaborations and partnerships with other companies and organizations to research, develop, and commercialize new treatments. Their goal is to deliver breakthrough medicines that help patients around the world. Their market cap is currently sitting at $154.2 billion, and in 2021, they generated a revenue of $46.4 billion. Their dividend yield is sitting at just under 3%. 64% of their revenue is generated from the United States, 24% of the revenue comes from Europe, and the remaining 12% comes from other regions around the world. So they're mostly located in the United States and Europe. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can either increase or decrease based on the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors on a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from the margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from the margin of safety. The first 2 ratios that we're going to look at are the EBIT growth and the margin growth. As you can see, the EBIT has grown from $17.6 billion in 2012 to $46.4 billion in 2021. The average growth in EBIT during this period was 17.9%, meaning a 5% deduction from our margin of safety. The margin has somewhat stayed flat, but it has gone down just a little bit over the past years, going from 25.2% in 2012 to 21.2% in 2021. The average growth here was very limited at 0.28% growth, meaning no change in our margin of safety. The next 2 ratios that we're going to look at are the dividend growth and the payout ratio. The dividends have gone from $1.44 a share annually in 2013 to $2.16 a share annually in 2021, with the biggest increases being in 2019, 2020, and 2021. The average growth in dividends during this period was a small 5.3%, so no change in the margin of safety. The payout ratio is sitting at a relatively high 70.4% payout ratio, but it's just under the red part of our scale, so no change in our margin of safety. The final 2 ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, you have to take the debt of Bristol Myers, subtract the cash, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Bristol Myers, it's just over 2 years, so a ratio of 207%, meaning no change in our margin of safety. The return on invested capital for Bristol Myers is sitting at 8.3%, which once again means no change in our margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Bristol Myers Squibb. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow growing from 2012 to 2021. The average growth in free cash flow during this period was 27.4%, but since we're calculating the lifetime expected growth of the company in free cash flow, I've gone with a very conservative 2.7%. I'll come back to that later why I've chosen a very small percentage here. With this percentage, we can determine the future free cash flow for Bristol Myers and determine the terminal year of valuation using a 3% perpetual growth rate and a discount rate of 9%. Out of this, we get a sum of free cash flow of $308.5 billion. The last thing we have to do to get our equity value is add our cash and equivalents and subtract the debt. Then we get an equity value of $280.1 billion. And to get our discounted cash flow price per share, all we have to do is divide it by the shares outstanding, which for Bristol Myers is 2.1 billion shares. The discounted cash flow price per share here is $132.13, and with the current price of $72.51, we get an upside of $59.62, which is over 80% upside. I've gone with a very conservative growth estimate since the upside is already really high here. If we were to even add a decreasing growth rate of 5%, it would still be near fair value currently. So that shows that the discounted cash flow is very strong for Bristol Myers. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth in dividends here was 7.8%. And since we're once again calculating the lifetime expected growth of dividends here, I've gone with 60% of this growth rate, since it's around the average of what Bristol Myers increased their dividends by in the last 10 years. We'll once again be using a discount rate of 9% in this valuation. And out of this model, we get a price per share of $52.62. And with the current price of $72.51, here the downside is $19.89, which is a 27.43% downside. The last model that we'll be using is the multiple valuation. By looking at companies that do similar business to Bristol Myers, looking at their stock price and their earnings per share, we can determine an average PE multiple in the industry. In this case, the average PE here is 23.4. All that's left to do to get our fair value here is multiply it by the earnings per share that Bristol Myers is generating, which is $3.07 a share. Out of this, we get a fair value of $71.82. And with the current price of once again $72.51, here the downside is 69 cents, which is a 1% downside. Let's go look at the final overview of our valuation model next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, and multiple valuation price per share. Out of this, we get an average of $85.53. If we were to not use a margin of safety at all, we would get an upside of almost 18%, but we have calculated our margin of safety prior to this, using a standard margin of safety of 25% and deducting 5% for the EBIT growth. Then, applying the margin of safety, we get a fair value of $68.42, and with the current price of $72.51, this leaves us with a downside of 5.64%. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.